Investing in real estate can be incredibly challenging. And if you're not careful, you can even lose a lot of money. But today we're going to talk about the top three tax benefits of investing in real estate that will make a huge difference and keep you from being one of those people who loses money in the game of real estate. The first thing we're going to talk about is called depreciation. Rod, give us an idea of what depreciation is, why it's important, and how to use it.
So basically, the IRS puts a schedule on how long something is going to last. So the actual real estate, 27 and a half years, but your real estate has carpet and doors and the roof and everything else, and those each have a different schedule. Well, what that means is that each year you get to take a depreciation, or in other words, a deduction against your income for that year to reduce the amount of taxes that you pay. But it even gets better. There's what's called bonus depreciation, where you can actually accelerate that depreciation up to the first year where you make the purchase of the property. And you can imagine that creates a huge tax benefit in that first year, so that against your income, you have very little, if any, that you end up paying in tax.
And again, it's incredibly powerful because we're getting all of the benefit in that first year. And so, what I have the ability to do as an investor is to continue to invest year after year, property after property. And as I do that, I continually get that big tax benefit, which can keep my income in check from year to year. And then, Rod, we can be really efficient by taking things to the next level and using leverage. Talk about why leverage helps kind of take this to the next level.
Yeah, most people I know, when they buy a piece of property, they're not just buying it outright. They put maybe 20-25% down and then get a loan for the rest. Well, guess what? You get the depreciation on the full amount, not just what you put into it. So what it does is it creates a scenario where I've seen it in a lot of cases where in that first year, it creates a larger deduction than you have on any income, which means that now you have a loss, but you get to carry that forward. So it's creating multiple years worth of tax benefits because of this combination of the bonus depreciation, and then when you leverage it and create a much larger schedule on that depreciation.
So by utilizing the combination of leverage and tax benefits, we can drastically increase the return. And that's another way to think of the value of depreciation, is quite literally improving my return. And we've seen many situations where that return can almost be doubled just by adding those tax benefits. So we know that taxes are the biggest wealth deteriorator. They have the biggest drag on return. So if I can go ahead and minimize taxes, optimize the amount that I'm paying, then suddenly my return goes way up. The second thing we're going to talk about is called the 1031 exchange. And the 1031 exchange is just a simple IRS guideline that allows us to sell a piece of property that we own, move it to another property without paying any capital gains taxes, right? Normally, when I sell a property, I'm stuck with whatever the capital gain is. It could be if it's a short term, it's going to be 35, 40%. If it's a long term, it's going to be 15 to 20%. But regardless, I'm paying this massive tax burden whenever I sell a property. But if I utilize a 1031 exchange, I can move that into the next property, and that tax just goes into the next property. So by doing that, I can be really strategic and make sure that I'm selling at the right time, or potentially not selling and eventually passing it on to the next generation. And by doing that, I'm going to create like this full circle of generational wealth.
Yeah, I think that's really the key, because the first benefit we talked about, as far as depreciation, wouldn't be a benefit if we just ended up pushing our basis lower and then we sell the property and we just have to pay all the tax on it at the time of the sale. Because we can do the 1031 exchange and push that into the next property, that's what creates a true tax savings in the depreciation moving into the 1031 exchange.
Yeah, that's a really great point. It's important to know that there are some rules and regulations surrounding depreciation, surrounding a 1031 exchange. We have to know in advance. We have to identify specific properties. We have to do it within a certain time frame. But as long as I abide by those and make sure that I'm doing it on schedule, it's a really, really powerful way to defer tax to a future point. And then what's really cool is we can use our number 3 tax benefit to never pay taxes. Well, that sounds great, right?
Yeah.
Okay, so number 3 is a stepped up in basis, which just means that at the time of death, a piece of real estate gets the stepped up in basis on the tax basis. So let's say it this way. So let's say that I own a piece of property. Let's say that I bought it for $500,000, right? Let's say it's 10 years ago. I buy this property, $500,000. It's now worth $1 million. I die tomorrow. If I die tomorrow, I own that property. Instead of my heirs having to pay the capital gains tax on that 500 to a million, that's going to go to them with now $1 million tax basis, right? So that means they can go sell it immediately and they don't have to pay anything in tax. So again, what happens here is that we take this full circle. We create the depreciation on the front end, the bonus depreciation. We utilize the cost seg analysis. And then by utilizing the 1031 exchange, I can roll that along. And eventually I'm bringing it into a stepped up in basis. And I've literally come full circle and never had to pay any tax on my real estate. That's powerful.
Yeah, and we've seen situations where people are at the time of their passing, they have millions of dollars worth of gains that get basically erased because now the basis immediately increases to the current market value. And it again, so we talked about tax savings, right? Depreciation creates that. We push it into the 1031 exchange. And then ultimately with that step up in basis, it's completely eliminated. There is no tax to be paid by your heirs. You have created a true tax savings, which isn't the case in a lot of things we talked about, right? 401k IRAs, that's pushing the tax down the road. You're going to eventually pay that. Someone is going to, right? Even if you keep it when you die, your heirs will pay for it, but not
one way or another. So my grandpa passed away at the ripe old age of 97, just earlier this year, or I guess just last year. And he was a prolific real estate investor. And as a grandson, I was fortunate to be the beneficiary of some of that, which was incredible because he purchased, I'm not kidding. So we got some real estate that he purchased in like the 60s, maybe it was the early 70s, but it was like 50 years ago. It had very little cost basis to it, tax basis to it. So he bought these fourplexes for, pennies on the dollar for today. When he passed away, we got that money and no tax implication at all. Again, that's how we create generational wealth. And that's how the wealthy families have done it. They've learned the tax code in a way that allows them to create generational wealth by avoiding those major pitfalls, which again, taxes is probably right at the front of that list. So all that said, there's a lot more to investing in real estate than just the 3 tax benefits we've talked about today. Click on the screen to learn more.